Have you ever wondered what it actually takes to build the AI you use every single day? Not the app on your phone, not the chatbot window, but the actual physical machinery behind it? Because right now, the world is pouring more money into artificial intelligence than it has ever poured into any single piece of technology in modern history. And today I want to walk you through exactly where that money is going, why it's happening this fast, and whether any of it will actually pay off. Stick with me, because by the end of this you're going to look at every AI headline completely differently. Let's start with a number that should stop you in your tracks. Global spending on artificial intelligence across the entire stack of hardware, software, services, and models is projected to hit $2.59 trillion this year. That's not a typo. Trillion with a T. And here's the wild part. That number was already revised upward mid-year from an earlier estimate, adding around $70 billion almost out of nowhere, just because demand for AI infrastructure and these new autonomous agent tools kept accelerating faster than anyone predicted. To put that in perspective, AI is now expected to eat up around 41% of the entire global IT budget. A year ago, that share was closer to 32%.
Think about that.
Nearly half of every dollar companies spend on technology this year is going toward artificial intelligence in some form. Now, if you break that giant number down, the biggest single chunk isn't software, and it isn't fancy new models. It's infrastructure. Servers, chips, data centers, the actual physical guts of AI. That segment alone accounts for close to half of all spending. Right behind it is something you might not expect: AI services, meaning the consulting firms and integrators that companies pay just to help them figure out how to actually use this technology without breaking everything. And here's a fun little detail buried in the data. The fastest growing category of all isn't infrastructure or services. It's agentic AI software, the tools designed to actually take autonomous, multi-step actions on their own. Spending there is expected to more than double in a single year. But, and this is important, only around 17% of organizations have actually managed to get a fully functional AI agent up and running. Up to 40% of these early agent projects are at real risk of just being canceled outright. So we've got this massive gold rush happening, but a huge amount of it is still speculative. Okay, now let's talk about who's actually writing these enormous checks, because this is where it gets fascinating. The 5 biggest tech giants in the world, Amazon, Microsoft, Alphabet, Meta, and Oracle, are collectively pushing towards $700 billion in capital spending. Just the top 4 U.S. hyperscalers alone are guiding toward around $725 billion, a jump of 77% from the year before. Microsoft and Amazon are each roughly doubling their spending. Alphabet's not far behind. Why would any company voluntarily double its spending in a single year?
Fear.
Genuine fear of missing out on capacity. Microsoft actually disclosed an $80 billion backlog of cloud orders it physically could not fulfill because it didn't have enough power or infrastructure. When you're turning away $80 billion in business because you literally don't have enough computers plugged in, you understand why every CEO in this space is telling their board to spend now and ask questions later. But here's the catch nobody likes to talk about. This spending spree is starting to break the traditional way big tech companies fund themselves. Historically, these giants funded growth out of their own cash flow. Not anymore. They've collectively raised over $100 billion in new debt, and analysts think the broader tech sector might need to issue up to $1.5 trillion in debt just to keep this pace going.
Why?
Because roughly 2/3 of this capital is going toward assets that depreciate fast. Specialized AI chips are typically written off over 5 to 6 years on the books, but in reality, the actual useful life of these chips before they're technologically obsolete is closer to 2 to 3 years. That creates what people are calling a capital treadmill, where companies have to keep reinvesting in new chips before they've even finished paying off the old ones. It's part of why Amazon's free cash flow, a key measure of financial health, dropped 95% year over year in one recent quarter, down to just $1.2 billion. That's a company that used to generate mountains of cash, suddenly running on fumes because it's plowing everything back into data centers and chips. So, where physically does all this money go? Let's break it down piece by piece, because I think this is genuinely fascinating. About $180 billion goes toward the actual chips, the GPUs and accelerators, and here's the kicker: One company, NVIDIA, controls over 90% of that market. Another $120 billion goes into literally constructing data centers, specialized buildings engineered to handle extreme weight loads and unique power and cooling demands. $50 billion goes into high-speed networking to keep all these chips talking to each other without delays. $40 billion goes into memory chips. $25 billion goes into advanced cooling systems, because when you cram this many chips into one space, air conditioning alone just can't cut it anymore. You need liquid cooling running directly across the chips. And $20 billion goes straight into power infrastructure, transformers, switchgear, generators, just to get electricity where it needs to go. And speaking of power, this might be the single most important bottleneck in the entire AI industry right now, more important than chips, more important than money. According to the International Energy Agency, the electricity consumed by data centers globally is on track to double by the end of the decade, reaching roughly the same annual electricity demand as an entire country like Japan or Canada. In the United States, which hosts nearly half of the world's data center capacity, these facilities could account for up to 12% of the entire nation's electricity consumption within just a couple of years, up from around 4% not that long ago. And here's the twist. The real bottleneck isn't even generating that electricity, it's getting it connected to the grid. You can build a data center in 2 to 3 years, but getting a high-voltage grid connection approved can take anywhere from 4 to 10 years in the US and Europe. That mismatch is forcing companies to get creative, striking direct power deals with existing power plants, building their own on-site natural gas generators, even signing agreements to restart old nuclear power plants. One deal alone, between CoreWeave and Core Scientific, was worth $9 billion specifically to lock down over a gigawatt of power that already existed on the grid, because waiting years for a new connection just wasn't an option. Now, let's zoom out even further, because this isn't just a corporate story, it's becoming a geopolitical one. The United States and China together control over 90% of the world's AI data center capacity. Everyone else is scrambling to keep up. The U.S. government alone has committed around $471 billion cumulatively toward AI strategy. China's put in about $119 billion. But watch this, sovereign wealth funds are becoming massive players too. Abu Dhabi's tech investment vehicle, called MGX, closed a fund worth $49 billion, blowing past its original target, and it's using that money to take stakes directly in companies like OpenAI and Anthropic, while also co-leading a $40 billion physical data center project alongside BlackRock and Microsoft. Countries like India and Japan are running their own national strategies too, India investing in multilingual AI models to serve hundreds of millions of citizens across 22 official languages, and Japan committing over $6 billion specifically because its youth unemployment is so low that it needs automation just to keep its economy running. There's even a term for the risk this creates, something called a sovereignty leak, where a country builds its public services, tax systems, health records, even border control, on top of foreign-owned cloud infrastructure. Even if the data physically sits inside that country's borders, the legal and operational control can still belong to a foreign company. Once that infrastructure gets baked into how a government actually runs, that dependency becomes almost impossible to unwind. Alright, so here's the billion-dollar question, and I mean that literally. Is any of this actually going to pay off? Because right now there's a massive, almost uncomfortable gap between how much is being spent and how much money AI is actually bringing in. Some analysts are sounding serious alarms. One firm has argued the current AI valuation bubble looks even more extreme than the dot-com crash, estimating it's many times larger in relative scale. There are even prominent investors publicly betting against hardware manufacturers, arguing that real demand from actual paying customers is much smaller than it looks, and that a lot of this spending is really just companies funding each other in circular deals. On the other hand, firms like Goldman Sachs push back on the bubble narrative, pointing out that today's biggest spenders have strong balance sheets, real cash flow, and actual cloud revenue, not just speculative promises, which is very different from how the dot-com era played out. But even the optimists acknowledge the numbers are tight. Estimates suggest the entire AI ecosystem needs to generate somewhere between $600 and $650 billion a year in actual end-user revenue just to cover the depreciation and operating costs of all the GPUs that have already been installed. Some projections say that total could rise to $2 trillion by the end of the decade. And where are we now? OpenAI, the biggest name in the space, is generating an annual revenue run rate somewhere between $20 and $25 billion. Anthropic is around $9 billion. Even when you add up every dollar of AI-related cloud revenue across every major provider, you're looking at maybe $50 to $150 billion total. That's still a massive gap compared to the hundreds of billions being spent every single year to build the capacity in the first place. And this is where it gets almost philosophical. Why is the payoff taking so long? Economists point to something called the productivity J-curve. Basically, every major transformative technology in history, electricity, the steam engine, computers, required huge complementary investments in retraining workers and redesigning entire workflows before the productivity gains actually showed up in the numbers. In the early years, all that investment looks like pure cost with no visible return, even though the benefits are quietly being built underneath the surface. One Nobel Prize-winning economist has actually projected that AI might only add somewhere between 1 and 1.6% to total labor productivity over an entire decade, a surprisingly modest number given how much hype surrounds this technology. And in the corporate world, this plays out exactly as you'd expect, with research from MIT and Stanford finding that around 95% of enterprise AI pilot programs fail to ever make it into real, live production use. Not because the AI itself doesn't work, but because of messy internal data, clunky old workflows, and organizations simply not being ready to absorb the change yet. So where does that leave us? We've got trillions of dollars flowing into physical infrastructure, chips, power plants, and cooling systems at a pace the world has never seen before. We've got companies taking on unprecedented debt, betting that missing this moment would be far more costly than overspending on it. We've got entire nations treating computing power as a matter of national security. And we've got a genuine, unresolved tension between how much is being invested and how much value has actually shown up so far. Whether this turns out to be the greatest infrastructure investment in modern history or one of its biggest financial miscalculations probably won't be clear for years. But one thing is certain, whatever happens next in artificial intelligence isn't going to be decided in a boardroom or a research lab. It's going to be decided by power grids, chip factories, and cooling systems, the unglamorous physical machinery that the entire digital future is quietly being built on top of. So next time you open up an AI chatbot and type in a question, just remember, somewhere behind that simple little text box sits a gigawatt power plant, a queue for chips that's booked out a year and a half in advance, and $1 trillion bet that all of this is actually going to work.